Most accurate Forex trading indicators. By the Beach Trader, Freedom Lifestyle. 5 highly effective trading indicators. Number 1, moving average. Plotted line that measures the average price of a currency pair over a period of time. Number 2, the RSI, Relative Strength Index. Helps you determine when a currency is overbought or oversold, so a reversal is likely. Number 3, slow Stochastic. Unique aspect is 2 lines, the percentage K and percentage D line that signals when to enter trades. The MACD, moving average, convergence, and divergence. Moving averages provide a visual display of changes in momentum. Number 5, Bollinger Bands, used to determine entry and exit points for a trade. The bands are often used to determine overbought and oversold conditions. Moving average. A moving average is widely used indicator in technical analysts that helps smooth out price action by filtering out the noise of random short-term price fluctuations. It is a trend following or lagging indicator because it is based on past prices. This is an important point. We don't know that a trend exists until it is already in place. There are different types of calculations which can be used to create moving averages, but the 2 most popular are simple and exponential. The simple moving average, SMA, calculates the arithmetic mean of price over a certain look-back period. The exponential moving average starts with the simple moving average, SMA, and then calculates a multiplier for weighting the EMA. Without getting into the specifics of the math, we need to know is that an EMA gives more weight to recent prices, while the SMA assigns equal weight to all prices. Moving average. 50-period SMA, simple moving average, overall trend direction. Also provides signals for upcoming price moves. In addition, the moving average line can act as an important support and resistance. 50-period EMA, exponential moving average. Forex traders frequently use it because it puts more emphasis on more recent periods. So here's a chart. The 50-period EMA is in blue, as we see right here. And the 50-period SMA is in red. So when these lines cross, this is when it goes in one way or the other. If the red line goes over the blue line, that means that it's on a downtrend. When the blue line goes over the red line, that means it's in an uptrend, like right here. This is an uptrend. So every time it crosses, a little bit after that, it's going to move in that direction as a trend. And that's how you read this. So if we look again, here we go. A long signal. It's going up, right? This is what we call a fake signal because it's in the middle. It's not going up or down. And then right here again, a short signal. Do you see how this line crossed right here and went underneath? That means it's going to go up. When this line is on top, right here where the line goes on top, this is when it's going to short and fall. And when the line goes underneath again, it's going to go up. Very simple. So the RSI, Relative Strength Index. The Relative Strength Index, or RSI, is an isolator that is simple and helpful in its application. Isolators like the RSI help you determine when a currency is overbought or oversold, so a reversal is likely. For those who like to buy low and sell high, the RSI might be the right indicator for you. RSI Advantage. It's a very good Forex indicator used in combination with other Forex trading strategies as a means of confirmation to trade or not to trade. Try to combine RSI trading strategy with other indicators. One of the disadvantages tends to give false signals and monitoring is required. You need to combine RSI with others to make it work effective. And that's what you'll find. One indicator is not good enough. You need at least 3 to 5 indicators working together to really give you the call that you want. So this is what we're looking at right here. This is the RSI chart. So when it hits this bottom line right here, this is called the 30 line on this chart. It could be different numbers, but when it hits this, it's going to bounce back up. And when it goes over or hits this line right here, we know that it's overbought right here, so it's going to go back down. So overbought is when it hits the top line here. Underbought or oversold is when it hits the bottom line. And that's what you need to know basically. So let's look again. This is a live candle chart right here. So it says to buy right here. Why do we want to buy? Because look, it's hitting the 30-point line on the bottom. It went underneath it. So we know there's going to be a reversal and it's going to go back up. So what happened? When it hit the line right here, it went back up, shot up, right? And then it just stayed in the middle, which is not a trend. It's not an up or down trend. And then look what happened. It hit right here at the top. That's right here. And then what do we think is next going to happen? If we can predict, is this going to go up or do we think it's going to go back down? Well, we know when it hits the top, that means it's going to go back down. When it hits the bottom here, that means it's going to go up. So that's RSI. So the slow Stochastics. Slow Stochastics are an isolator like the RSI that can help you locate overbought or oversold environments, likely making a reversal in price. The unique aspect of trading with the Stochastic indicator is the two lines, the percentage K and the percentage D line, to signal our entry. Because the oscillator has the same overbought or oversold readings, you simply look for the percentage K line to cross above the percentage D line through the 20 level to identify a solid buy signal in the direction of the trend. Remember, in the direction of the trend. So here we go right here. This is a slow Stochastic, and you look here on the bottom. When it hits this, when it hits that, this is what we're talking about. So let's look. Upward trend. An upward trend line, then buy call. That's when you're going to get a call on cross above the oversold level below 20. So when the lines cross right here, the blue lines and the red lines, as you can see on the bottom, when they cross on the bottom, that means it's going to go up. A downward trend. Downward trend line, then sell, put, or cross below the overbought level above 80. So right there, if you look at the 80, you look right here, when these lines cross, that's when it's going to go in the other direction. You see the lines crossed right here above the 80. That means it's going down. When it crossed right here again, it went back up. When it crossed again, then it dropped. Drop, drop, drop. So look, what we're looking for is when this red and blue line cross. So what kind of trend are we in right now? Well, if we draw a line right here, this blue line tells us we're in a rising trend or upward trend. So when are we going to make the call? Or are we going to make a put? Well, we're going to make a call because we know that it's in an upward trend. So we want to catch it when it hits low, and then we got it going up. Like right here, it hit low. Look how many times it went up. Then it went back down a little bit. We might not catch that put to go back down. Why? Because it's dangerous, because we know we're in an uptrend. So we want to catch it when it goes down. It went down right here and it started going back up. Look, we catch it and we're winning. It goes down again. We caught it again. Do you see how there's more greens than red, which means we're in an upward trend. It keeps on going up, keeps on going up, 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 up. Okay. So this is a very good indicator. When the lines cross in overbought and oversold levels, that's when we're going to place our trade. A sell signal occurs when a decreasing percentage K line crosses below the percentage D line in the overbought region. Conversely, a buy signal occurs when an increasing percentage K line crosses above the percentage D line in the oversold region. MACD, moving average, convergence, and divergence. The moving average, convergence, and divergence is designed to reveal changes in the strength, direction, momentum, and duration of a trend. interpreted in several ways, but the more common methods are crossovers, divergences, and rapid rises and falls. MACD is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. This triggers technical signals when it crosses above to buy or below to sell its signal line. The speed of a market is overbought or oversold. MACD helps investors understand whether the bullish or bearish movement in the price is strengthening or weakening. So MAC is often displayed with the histogram. And I want you to see this chart below, which graphs the distance between the MACD and its signal line. If the MACD is above the MACD's baseline, if the MACD is below its signal line, the histogram will be below the MACD's baseline. Traders use the MACD's histogram to identify when bullish or bearish momentum is high. One of the main problems with divergence is that it can often signal a possible reversal, but then no actual reversal actually happens. It produces a false positive. The other problem is that divergence doesn't forecast all reversals. In other words, it predicts too many reversals that don't occur and not enough real price reversals. So that's why you have to have other instruments with it. But let's look right here. So this is the histogram part right here that we're talking about. And you see it crossed up right here. And what happens? Once it crosses, do you see how right here, when it didn't cross, it's going up, right? This is when it started going up. When it crossed, it went up. When the line crossed and the orange one, the signal line's on top, then what does it do? It goes down. When the blue's on the bottom, it goes down, 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 down. And when it goes below this line, right, this is a baseline. And then when it crossed right here, it started going back up. So that's how we could tell when the lines cross. It crossed right here. It's over. This is the baseline right here. It goes over, right? It crossed right here. It started moving up. It crossed right here, right? It started moving down. That's where we got this big push and momentum moving down. So the blue line was where it was on the bottom. So that means that it's moving in an upward trend. Now when the blue line's on top, it's in a downward, right? And then when it goes back on, the blue line's on the bottom again, then it goes back up. It's a great indicator, but you have to use different indicators with it. So this is another way to look. The MACD, the histogram is very beautiful because you can see, you know, these candlesticks on the bottom. Where is it going? Is it red or is it green, right? And they're all together. So let's look again. So this is the bullish divergence. So bullish, it tells you that it's moving which way? Exactly. And then the bearish, when it's bearish, it's going to cross over here and it's going to change. So let's look again. The bullish is going from what? Going from going up, then it's going back down, and we're catching that. And then right here, the bearish, right, is going from up and it's moving back down. So that's what we're talking about. The Bollinger Bands. The Bollinger Bands, this is the last one we're going to talk about today. This is a very important one that you should probably put in all your trading indicators to work together. This is one of the first ones that you should be using. A Bollinger Band is a technical analyst tool defined by a set of trend lines plotted 2 standard deviations positively and negatively away from a simple moving average SMA of the price, but which can be adjusted to user preferences. Bollinger Bands are developed and copyrighted by famous technical trader John Bollinger. Now, this guy was one of the masters of trading, designed to discover opportunities that give investors a higher probability of properly identifying when an asset is oversold or overbought. So, Bollinger Bands are technical analyst tools developed by John Bollinger to generate oversold and overbought signals. There are 3 lines that compose this. So let's look here. So, a simple moving average middle band. So the middle band is the black line in the middle. That's your moving average band. Okay, and an upper and lower band. The upper and lower bands are typically 2 standard deviations from a 20-day simple moving average, but can be modified, a highly popular technique. Many traders believe the closer the prices move to the upper band, the more overbought the market, and the closer the prices move to the lower band, the more oversold the market. So John Bollinger has a set of 22 rules to follow when using the bands as a trading system. But just because of this presentation, you're going to have to look that up yourself. They are simple, one indicator designed to provide traders with information regarding price volatility. So when it goes to the upper band and it gets the upper band, guess what? It's going to go back down most of the time. If you see right here, it hits right here at the top of this candle wick. And what happens? It goes back down, right? And then when it hits this on the bottom, what does it do? It hits right here on the bottom of the band and it goes back up. And what you want to look for is this moving average. It should be in the middle of the trades. So it hits right here again. What do we think is going to happen when this green one hit? Do we think it's going to keep on exploding out of the band? No. We know what's going to happen. What comes up must come down at this point. So we're looking for it to come down. So if you can catch it when it hits the top or the bottom of the band, you know that you got a reversal, and that's when you're going to win. So John Bollinger suggests using them with 2 or 3 other non-correlated indicators. So you have to use them with different indicators that are not correlated to the Bollinger Band. He believes it is crucial to use these indicators based on different types of data. Some of his favorite technical techniques are moving average, divergence, convergence. So he uses this with the MACD, and then on balance volume and relative strength index, the RSI. So what I would like to do is use most of these together, and I want to show you guys what that looks like. I'm going to go ahead and get out of here. So we're going to look at dailyfx.com. If you see at the top, this is dailyfx.com, and it's going to give you some free indicators. That's why we use it. There's also a trade viewer that you have to basically buy to get these little trade things. So we're going to scroll down right here, and we can switch this up. We're going to do 1 minute because why? Because we're doing HFX. We're going to do 1 minute trades with Ethereum. So we hit the 1 minute. This is a 1 minute graph of what's going on. Now we're going to go to indicators. So let's put on first, I want you guys to see the Bollinger Band. The Bollinger Bands. So now we added the Bollinger Bands right here. This is the green is the top, right? We're in the band. That's the moving average that we were talking about in the bottom band. So when it hits the bottom band, what happens? It goes back up. When it hits the top band, it goes back down. This is all we're looking for. Right here, it hit the top of the band. What happened? It went back down. So is that a good trade signal? I believe so. It hit right here. It went back down. So it's doing exactly. And what are we on? The moving average is telling us we're in an upward trend. So we're in an upward trend. So what we want to do is catch it when it hits the bottom of the band and get it going up. Catch it when it hits the bottom and get it going back up. Right here it hit and it went up for, minutes, about 30 minutes it started going up. Okay, now let's go to another indicator. I want to show you guys. Let's look at the RSI, relative strength index. So the relative strength index is under here, right here. So this is telling us when it hits the bottom of this right here, it's going to go back up. This is the 40 line on the bottom, the 80 line on the top. So it hit right here. What happened? It reversed. It went up like we said. When it hit the top, what happened? It reversed, went back down. It went over for a while, and then what do we know? It's going to go back down. Okay, let's look at the slow Stochastic. So here we go again. Remember, when the lines cross, that's when it's going to go the other direction. So line crossed right here. What happened? It went up. Blue lines on top is going up. Line crossed right here. The blue lines on the bottom, it went down. Lines crossed again, it went up. Lines crossed again, it went down. Lines crossed again, it went up. So this is what we're picking reversals. Once the lines cross, then we know right here, it crossed right here. What do we know it's going to happen? It's going to have a big candle right here. This is the histogram we are talking about, right? So I want you guys to understand these indicators and what they mean. And let's try to do one more. I believe there's 4 that you can do at once. And I'm going to look for one more. Let's look at the MACD that we talked about. Okay, so that feature is not available, so you have to buy the program. But this is what it looks like in real time right here, right? Let's go ahead and get rid of the RSI, and let's use the other indicator, the MACD. And now we have that. Now we have this beautiful histogram, right? And we know when it crosses right here. It goes up, green, 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 green. Then it crosses right here. It starts going down. You see that? So we're just looking for when it crosses, and we can see this beautiful histogram on the bottom right here of green and red. It crossed right here. The blue was on top. It was green. It means it's going up. When the blue went underneath the line, the red one, then it's going down. So it's very easy to tell when you're using these indicators together how to get these good calls. So thank you so much. Once again, this is the Beach Trader. Hope you guys like and subscribe. Hope you guys learned a lot. And you guys have a great day. And please come back and learn more. And let's make money together. Bye-bye.